Hello everyone. In this video I am going to explain what is break-even point, how to calculate break-even point, what are the necessary ingredients in the calculation of break-even point, and what is the importance and significance of break-even point in any industry or any business. Let's start from what is break-even point. Break-even point is a point or production level or production volume where the business incurs no profit and no loss. For example, at this point, business is not incurring any loss. Any revenue or any unit sold less than break-even point means that business would incur loss, and any revenue additional than break-even point means that business is incurring profit. To calculate break-even point, we must know our per unit revenue, our per unit variable cost, our per unit fixed cost. Our total fixed cost. Our per unit revenue is the selling price of the item we are selling. Per unit variable cost is the cost which is directly associated with the change in the production level or production volume. Total fixed costs are the costs which do not change with the production level or production volume and which would incur irrespective of what is our production level. For instance, the rent of business premises falls under the category of fixed cost, and the cost of timber for a wood seller would fall under the category of variable cost. The more you sell, the more timber you will require. One of the main ingredient in the calculation of break-even analysis is the contribution margin. The contribution margin is revenue less variable cost. Suppose your revenue is $100 and your variable cost, which means the cost which is directly associated with the production, is 80, then your contribution margin is 20, or to calculate this way, 20%. We must be able to find out, we should be able to find out the break-even point if we divide the contribution margin with our fixed cost. I covered these concepts really briefly before moving forward to the model, just to clarify what every aspect of the break-even point means, so it will be easier for you to understand this model. Now, here is the break-even analysis template or model which would help you to understand how break-even analysis is calculated. Here is the per unit revenue. For example, if you sell any product for 100, if the variable cost or cost which is directly associated with any product is 60, assume these are per unit cost. Now the contribution margin will be revenue minus variable cost. It means 40. Let's also calculate percentage. Now suppose your fixed cost is around $1,000. Now this model is helping you to understand what is our break-even point. By seeing the graph, we can say that somewhere between 20 and 25, I think 25 units is our break-even point, as it can be seen in graph. Now let's also find out with the formula. Let's divide the contribution margin with fixed cost divided by contribution margin. 25 means 25 units must be sold to achieve break-even point, or alternatively we can also calculate in dollar terms. Let's divide fixed cost by contribution margin percentage. This would give 2500. So it shows 25 units must be sold to cover all the business related costs, or $2,500 revenue earning or sales must be done to achieve break-even point. You can see after $30 or around $30, the revenues are more than total cost, this line. So beyond the 25 units sale, the business would start making profit, and below 25 units sale, the business would incur loss. Let me know if you have any additional question or require any further help. I'll be more than happy to answer your question. Thank you.